Hello, and welcome to everyone participating in today's webinar, Cost Principles under Uniform Guidance. My name is Yevgeny Zahenko, and I'm a manager at GRF CPAs Advisors, and I will be today's moderator. So before we dive in, just some quick housekeeping items and what everybody's going to need to do to get CPE credit for today's webinar. So anyone wanting CPE credit must complete and submit a short evaluation survey that's going to appear automatically following our webinar. You're going to be asked to recall and input some CPE words that we're going to give you throughout our webinar. Please write these words down as they will not be provided at the end. If you have any technical questions or any issues during our webinar, please use the chat function to speak with our administrator for assistance. The slide deck and the recording from today's webinar is going to be made available on our events page on our GRF website. And also any technical support or CPE questions may be addressed to Nathan at nmcelveen@grfcpa.com. And so today's learning objective is to provide an overview of the impact of uniform guidance on indirect rates and allocations for preparing an indirect cost rate proposal. And with that, I'll also introduce today's speakers. Paul Calabrese is a principal in the Outsourced Accounting Advisory Services Department at GRF. He brings a successful track record of working with government contractors. His career includes positions with the Air Force Audit Agency, the Defense Contract Audit Agency, and 3 government contractors, in addition to 20 plus years in public accounting. Mr. Calabrese's extensive experience with the cost accounting standards and the cost accounting standard disclosure statements, federal acquisition regulation cost principles, and the uniform guidance for federal grants positions him as a sought-after resource and consultant for all facets of federal government contract and grant cost accounting. Joe O'Mara is a senior audit manager at GRF CPAs Advisors. With more than 10 years of experience, Joe has developed specialized expertise in consulting international NGO clients on complex audit and accounting matters. Mr. Romero works with INGOs ranging in size from $500,000 to over $1 billion in annual revenues and missions that span several continents. As part of his role at GRF, he travels the world and visits remote locations to perform audit work for organizations with operations in Africa, Latin America, and the Middle East. And with that, I'll turn this presentation over to the speakers.
Thanks, Yev. Appreciate that. And welcome everyone. Paul and I are going to spend the next hour going through the key cost principles that are found in the Uniform Guidance, and subpart E of the Uniform Guidance is where you can find all of the different selected items of cost. And the 2 most important cost principles that we're going to spend a significant portion of time on are compensation and fringe benefits. Virtually every federal award that includes compensation, you're paying salary costs and being reimbursed by the federal government for it. And especially when we're considering the indirect rate, all of your general and administrative salary costs and fringe benefits, if you have a NICRA, will be flowing into the indirect cost rate. And the costs that are in your indirect rate must be allowable under 2 CFR 200 subpart E. And so that's really the focus of what Paul and I are trying to communicate as far as the different cost principles in this hour, to not only for direct costs, but really more importantly, and sometimes overlooked, the indirect costs, to ensure that you're aware of what is required, and so forth. And again, this is in 1 hour going to be more of an overview. There's a lot of detail in the cost principles and selected items. So one thing I would definitely encourage everyone is, as you're after this webinar, as you're thinking of different things, constantly go back to the cost principles and read them. And I probably on a daily basis, I go and look at some selected item of cost and reread what 2 CFR 200 says for that item of cost, just to make sure I'm not thinking what the requirement is, but I'm actually reading what the legal definition of the selected item is, to make sure I'm supporting and advising clients in the appropriate manner. So with that, let's dive into the compensation cost principle. And you'll note on every slide, we've included the actual reference to the regulation. So compensation is found at 2 CFR 200.430. So we've included that on here, and all the information we're presenting is pulled directly or paraphrased from those sections. So you can use that as a resource tool to go back and look at things. But so good news, starting off with the first cost principle, that compensation is an allowable cost under 2 CFR 200. It includes everything paid currently or accrued for services performed during the period of a performance period of a federal award. A lot of these cost principles, we're going to talk about the reasonableness and consistency, and compensation is definitely fits in that category. The federal government is willing to reimburse their fair share of any compensation costs that you incur directly or indirectly, as long as it's reasonable for work performed. The U.S. government does not want to be paying for any costs that you're just incurring simply because the fact that you have money from the government to pay for those costs. So, we'll constantly refer back to the reasonable factor, and as you go forward after this session, keep that in the back of your mind as well. Is this cost reasonable? It might be allowable under the cost principles, but if it's not reasonable in the circumstance, then it would not be something you should really be charging. The standards require that you have a written policy for how you handle compensation costs, and that your policy is consistent both between your federal awards and your non-federal activities. So again, they want to make sure what you're ultimately charging the federal government is consistent in how you would handle similar activities throughout your organization, and you're not increasing salaries or adding additional things just because the U.S. government is paying for it. The last item here that is an important aspect is the standard of documentation of personnel expenses. This is a section I would definitely highlight, take note of, and go and read through. As Paul and I were preparing for this, the standards of documentation for personnel expenses is something we could do a 2 or 3 hour webinar just on that one area. Because there are some very specific nuances that the federal government requires as far as how you document to support the compensation costs that you're being reimbursed for. But for sake of time, we're not going to dive into those standards, but we mention it to make sure that you go and look at it, or reach out to us if you have any questions on those standards. So again, I mentioned the reasonableness criteria. The U.S. government has an expectation that the compensation you're paying for employees working on federal awards or indirectly being charged to federal awards is consistent with that paid for similar work and other activities that you're not charging to the federal government. And if the type of activities you're doing on the federal award you don't have anything similar within the organization, then the federal government, the regulations would expect that you've done some sort of analysis, some sort of research into the labor market for that type of activity, and you're paying salary costs that's consistent with what the labor market would pay for similar services. So again, having a robust compensation policy and procedure to guide you, and really for a lot of the allowable costs that we'll talk about today, if you do not have a documented policy and procedure for it, then you kind of end up at the mercy of what the U.S. government says is reasonable for that type of cost. And they tend to be a lot more stringent on different things, versus if you have a policy and you're consistent on how you treat it between your federal awards and non-federal awards and other activities, then you're going to have a much better basis for charging those costs directly and indirectly to the federal government. So, really make sure your policies and procedures around your allowable costs are robust and really support what it is that your organization does, so that you're well protected. So then another area in the compensation cost principle talks about the outside professional activities. And this is really for any professional activities your employees are undertaking that are in addition to what their normal job duty, what they're currently being paid for, type thing. And so again, here, if you do not have a written policy or you don't have adequate definition as far as why this activity is permissible, why it's reasonable, the government will likely make you allocate a portion of their salary to that activity that is ultimately not going to be reimbursed from the federal government. See this often, with newer organizations that, are almost like a startup type thing, to where people are working overtime, extra hours to really help grow the organization and stuff. And from the U.S. government standpoint, that all needs to be treated consistent and equally. It's not a situation to where you can say, all right, well, the federal government's paying for the salary for the first 40 hours and we're going to reimburse them for that. And then everything the employee does beyond 40 hours is pro bono work because they care about the mission of the organization. The federal government will say, everything you're doing is based on the job, especially if you don't have a written policy around it. And so then therefore the salary cost should be allocated to all of those activities equitably. So within the cost principle, it talks a little bit about what are, in general, compensation is allowable, but there are situations in which it is not allowable or unallowable. And the first and foremost is, if a cost is unallowable under another cost principle, you can't all of a sudden flip it and say, oh, well, this is part of compensation for the employee, so therefore we're going to make an allowable cost. Clearly someone back in the day was a little tricky and tried sneaking that through. And so OMB decided to be explicit here and make it noted that, if it's not allowable under any other cost principle, you can't disguise it as a compensation type cost to an employee in order to make an allowable cost. We also note here there are certain federal agencies such as NIH and others will actually have statutory ceilings, or sometimes called salary caps, on the amount that you can charge the federal government for such employees. And so it's good to be aware of those situations. They're typically going to be found in your actual award agreement. And so then if you are in that sort of situation, making sure you have a good procedure within your accounting system to be able to correctly account for that cap, that ceiling of which the U.S. government will pay for it, and allocate the cost across that. There's also some special consideration in determining the allowability of compensation due to substantial change, increase in employees' level of compensation. If something changes to where an employee has a significant increase in responsibilities, you take on 5 additional federal awards, and so therefore, based upon your organization, HR manual policy, that employee is entitled to a significant increase in their pay. The federal government would agree, as long as it's reasonable with the increase of responsibilities, that is an allowable cost. If all of a sudden you decide to give everyone working on federal awards a 50% pay increase just because you're feeling generous that day, likely not going to consider that to be allowable. So again, you use good faith, good judgment as far as what is the rationale behind it, and really ensure you're documenting any of these things that might fall into a gray area. If your external auditors come around or a federal auditor, you have clear documentation, because the 2 people can read a cost principle and come to a different conclusion, but you're going to be in a lot better basis, whether you're talking with your auditor or whoever, if you have clear documentation as far as what your rationale was and that you did consider the cost principle at the time to reach your conclusion to include it as an allowable cost.
Perfect. Thanks, Joe. And so with that, we've reached our first polling question. And our question is, can incentive compensation be allowable if pursuant to an established plan, followed by the non-federal entity so consistently as to imply, in effect, an agreement to make such payment? Pretty simple responses: A for yes, B for no, and C for unsure. So while everybody's recording their responses, I'm going to provide the first CPE word. Our first CPE word for today's webinar is activity. Just a reminder, again, you're going to need these CPE words I'm going to provide throughout for the survey that you'll complete and submit if you want to receive CPE credit. Once again, the first CPE word is activity, ACTIVITY.
All right, so the results are in. About 4 out of 5 people said yes, this is an allowable cost. You know, and I would agree with that. That is the correct answer. You know, incentive-based compensation. I think a lot of times, you know, for the people that said no or unsure, it's not a common way of paying compensation in most, especially not nonprofit organizations. You know, there's typically not a lot of incentive pay, but the federal regulations and the cost principles do allow it. And if we advance to the next slide here, you'll see that, you know, there are some criteria though. You know, if it's based on cost reduction or efficient performance, suggestion or safety award, you know, as long as there's a written formal plan between the employee and the employer, and it's consistently applied, you know, then it is allowable. Type thing. So again, going back, as an auditor, I'm probably going to sound like a broken record by the end of this, but you know, ensuring you have a policy for it and there's clear documentation as far as, you know, what was the criteria for it, and ultimately what did that employee or employees do to meet that criteria, and that's consistent within the organization. It's not a unique compensation just because they're working on a federal award. Then the guidance would say that is an allowable cost.
All right. So now we're going to talk about the other cost principle, fringe benefits. That's equally important. Fringe benefits, as you know, relates to all the compensation. And these, as Joe and I determined, were probably the two most widely used or affected impacting cost principles on your organizations for those who have the federal award. Before I start, I just want to let you know that we are posting on our website with the PowerPoint a PDF that kind of is like a cheat sheet, and it lists all the cost principles, references to the 2 CFR 200, and we define them as like allowable, unallowable, allowable with restrictions, or unallowable with exceptions. So at least it will give you something to point you in the right direction. And as we start with fringe benefits, you probably have asked yourself the question, I know that they negotiate as a result of the cost principles, especially for nonprofits, a facility and administrative rate, which is what people might call M&G or G&A. And they kind of have the question, what about fringe rate? Some organizations like the Department of Justice does have a methodology for you to get an approved NICRA for a fringe rate. It's a little bit involved. For what I have seen on very, very large nonprofits or entities with HHS, if you've got a lot of direct awards, sometimes they'll offer if you want to do it. And those are the only two situations. Generally, when we prepare our NICRAs, we do include the fringe rate just for information because we're applying it to both direct and indirect labor. So fringe benefits is important, and as you can see from the slide above, it's pretty much what you would expect: payroll taxes, unemployment, Social Security, Medicaid, or Medicare, excuse me, the employee life, health insurance, vision, workers' comp, which is a specialized insurance that you may be paying through a group, I mean, not a group, but through your total insurance like liability, but we put it up in the fringe area. for allocation, pension, and some other benefits. Sometimes I'll just say, as far as, because we just talked about incentive compensation or bonus. Some people will put bonus in fringe, but when you put bonus in fringe, weird things can happen, so to speak. One year you may have a lot, another year you may have little or none. And so that we want to see indirect rates that are consistent from year to year, somewhere in the range. And so it does sometimes cause increased volatility. Also, it increases your fringe, because the fringe is just basically on total productive labor, and in your case, includes paid absence, excuse me. So total labor. Sometimes people put incentive compensation in the FNA, the facility administrative pool, simply because it's over a larger base and it relates to something that benefits the organization as a whole. So there's really no right or wrong answer, but I thought I would mention that. Okay, next slide. So that's the whole issue. How do we allocate fringe benefits? And basically, there are many, many, many different ways to do it. Again, it's just, are you consistent? Does it make sense where you're allocating it? And that really kind of leads us to the next polling question.
Great. Thanks, Paul. Thanks for teeing that up. So our second polling question is: the preferred method of allocating fringe benefit costs is by identifying specific benefits to specific individual employees. Once again, fairly simple responses: A for yes, B for no, and C for unsure. So while everybody's recording their responses, I'm going to provide the second CPE word. Our second word is employee. Once again, just a reminder, you're going to need these words I'm providing throughout for the survey to get your CPE credit. Once again, our second CPE word is employee, EMPLOYEE.
All right. And then the no's, 60% have it correct, that it's not the preferred way. There is no preferred way. So if we want to go to the next slide, it kind of addresses that. So you would think that assigning it, and first of all, let's just take a step back here. This is a depends kind of statement here by the uniform guidance. So you have many different ways that you can allocate. And so you could do it individually, like in the polling question, but it's no preference. You can allocate entity-wide or focus on different kinds of groups of fringe benefits. And so the groups of fringe benefits might be, hey, people are full-time or part-time. Sometimes they even call it tier 1 and tier 2 fringe, because there maybe are part-timers and they don't get a lot of the other benefits. So the most common, but doesn't mean it's the most preferred, is probably the one by allocating entity-wide. And then it just depends on how sophisticated the allocations become. The individual one, intuitive, you would think kind of makes sense. And this is really why there's indirect rates in the first place. If you're an organization, you're 5 or 10 people, some of you are probably thinking, well, gee, this person, we pay for their benefits because they're a single individual. They have no partner. And then for those who have partners or are married and those kinds of things, those individuals, they have a higher health insurance cost, which is true. And so if you probably had 5 or 10 people, it may make sense to you to do the fringe benefits, particularly the health insurance, on an individual basis. But when you're at 20, 50 to 100, to try to have a spreadsheet to manage that is almost ridiculous. And that's why the government, and one of the few things that they do very well, is they accept the concept of an indirect rate, where you put everything in a numerator, cost pool, and it's divided by a particular denominator, total labor. So for most nonprofits. So I hope that helps you intuitively. And individual really seems to make sense, but in actuality, it could be very time consuming. And thankfully, the government accepts these indirect rates. Okay, let's go to the next slide. So hope that the volume is there. And that is leave. If leave is done, vacation leave, paid absence, and so forth, it's generally done in two methods. It could be a cash basis or it can be accrual basis. So if you're doing things on a cash basis, then it's obviously going to happen in the period that you have the payment. And also it takes into consideration that if you have paid absence that's based on generally a taken basis, sick leave, holiday, those kinds of things, and the very specialized leaves that you might have, those make sense that it's just when it's taken, that's when you recognize it. Now, if we go to the next slide, on an accrual basis, we know that generally vacation for most entities or paid PTO, if it's all combined, you get a benefit if you leave. And so therefore it's on accrual basis, and it really, you're incurring it, it's accrued every month based on whatever leave benefit you're getting, you know, divided by the number of payrolls and so forth. And you're getting so much of a day or days for your pay period. And that happens regardless of where your balance is. So there are a little bit differences on it. Now, they do mention that if you're accruing vacation or paid absence, that it's the lesser of accrued or funded. And so they're kind of emphasizing that you would pay this, or I mean, that funds would be there to support it and not just have accrual that just stays out there forever. So that's what I interpret that to mean. If Joe, who is our expert auditor, would like to chime in, he is welcome to do so on accruals.
Yeah, I agree. You know, and I think most organizations, you know, if you think of it, you know, you're accruing a liability as you know, people work, but you're not actually paying that until they take the leave. So you have a liability sitting on the balance sheet, but that isn't paid out until, you know, an employee decides to take a vacation or so forth. And so under this method, if you're not funding that as it's being accrued, then it would become an allowable expense as you actually end up funding it by actually paying out that vacation cost to the employee when they're not working. So
Thanks.
Yep.
Keyman or key person insurance, basically it's a little bit different. What it is it's insuring the lives, you know, generally of, you know, either the executive director or someone high up, a COO, where basically they're the rainmakers, and God forbid, should they die, the organization gets the benefit from the policy. It's not, they have their own private insurance for their families, and that is not allowable. Other unallawables is obviously things like personal use of an auto, even though, and I'm talking about personal use, even if you report it on a W-2 or something like that, that still won't stand up to the test, so to speak. And obviously claims for workers' comp, unemployment, actual payments, all of that is fine. The general concepts with that is, you know, it's allowable in the year of it's being paid. You're following a consistent costing policy and measuring it according to these cost principles, which they provide more detail, and it's just allocated as an indirect cost. Okay. Post-retirement benefits, two ways. Pay as you go, so you record it when the payment's made. If you're going to accrue it, then basically what the rules are, you've got 6 months after your end as you made the accrual to fund it, or to fund it, I mean, obviously to pay it down. If you don't, then you go back to pay as you go. So that's pretty much the deal with post-retirement benefits. Severance pay is, I believe, the last one that we're going to discuss under the fringe benefits. And it's basically normal severance, and they call it normal or abnormal. Normal severance for people with a policy and a consistent practice, severance would be allowable. Abnormal severance really has to do with two things. One, the organization in this particular award is dealing more like a body shop. You hire a bunch of people to do something. When you're done, you have to let them go because there's no more work. Or golden parachutes, and generally those are unallowable. And it should be like everything else, allocated and benefiting all aspects of your non-federal entity. So it often and should probably go in the fringe bowl. It could go into G&A. Either way, we go to all of them. And then you can set up, you can't set up accruals, excuse me, for mass severance, but the government may help you with that. But it's through what we call prior written agreement or prior approval. Okay, next slide. So obviously golden parachutes are never going to be permitted where someone gets a tremendously large benefit for leaving. That's just not going to happen. Now you get into a situation where you have severance pay for foreign nationals outside the US, and generally if payments exceed the prevailing practice, it's not allowable, but also for ramping up or closing down. And we all understand that someone has to be there when you're ramping down operations to the end to kind of close the door and lock it up when you're finally done. And what you need to do again is get a prior written approval. What I would share with you and encourage, as we'll have mentioned and we will mention throughout the rest of the cost principles, when you think prior written approval, it's not necessarily anymore with a grants management officer. First of all, they've kind of moved some of that to the agency that negotiates your indirect rates. So you have to look carefully at the cost principle, but a lot of them now, they'd rather you go to, like HHS has a group called Cost Allocation Services, and you would talk to them about it. The reason why is it's just they're set up to deal with cost issues. And so that's something, but what I would suggest to you to avoid these problems is to put it in your budget narrative. As in your application, start to think if there's a few types of costs. Obviously, in this particular situation, the severance might even be considered a direct cost, but then again, of course, approval. So these specialized things, think of putting it in your budget narrative, and if they approve it, then you're good and set to go. So what we're going to do now is we're going to go over what we would call the everyday cost principles, just things, the more popular ones. We're not going over all the cost principles. We may only mention them simply because the item is allowable or unallowable. So take it away, Joe.
Thanks, Paul. So yeah, so the first one here is advisory cancels. Also think of it as your board of directors costs. And for the most part, these costs are considered not allowable or unallowable to be charged directly to the federal board, but they are allocable as an indirect cost. So you can include it in your indirect cost pool. To charge it directly, you would need prior approval from the awarding agency, like Paul just described. The next one is the easiest one. I think it's the one that probably doesn't have to be said, but it's the shortest cost principle in writing, and that's alcoholic beverages are never allowable under in any circumstance, or except for one very specific situation under the federal acquisition regulations. But under 2 CFR 200, any alcohol beverages are unallowable costs.
Joe, you got to tell them why. Situation.
Well, I just learned it from Paul this week, but when a new Navy ship is launched from port, they allow 1 bottle of champagne to christen the ship, essentially. So, but it still has to be a reasonable price. So a Dom Perignon for that christening.
It's a nice little fun fact, Joe.
Yeah.
All right, so getting into our third polling question, third and final. Our question is, cost of audits required by the Single Audit Act are allowable, but unallowable if A, single audit was not conducted in accordance with subpart F, B, the single audit was performed under the threshold of $750,000, C, all of the above, and D, for none of the above. So while everybody's recording their answers, I'm going to provide the third and final CPE word. That word is agency. Once again, you're going to need the words I've provided throughout and this third final CPE word for the survey to get your CPE credit. That last CPE word is agency, AGENCY.
All right, so the results here are a little mix of all the answers. Majority of the people though said all of the above, and that is the correct answer. So if we move on to the next slide here, you know, it makes sense that your single audit, you know, some people refer to it as uniform guidance audit. The cost that you pay your auditor for that audit are allowable costs. You're only incurring that cost because of your federal funding. You know, but the federal government says, well, wait a second, there's a couple instances to where we're not going to pay for that cost. And the first is if the single audit was not conducted in accordance with subpart F. So that's the next section in 2 CFR 200. It's the roadmap for us auditors as far as how we perform the single audit of organizations. And so the federal government says that if the single audit is not conducted in accordance with that, following those standards, then they don't want to pay for that cost. And so I think that's a cautionary tale for organizations to really make sure, you know, especially if you're new to single audits. You know, there was a lot of new funding last year, so a lot of organizations will be going through a single audit for the first time. You know, really make sure that your auditor is knowledgeable and with the Single Audit Act and Subpart F. Otherwise, you know, you might get through the end of the process and find out they didn't conduct it in accordance with the regulations, and all of a sudden those costs you're going to have to find unrestricted funding to cover them. The other reason the federal government will not pay for it is if the single audit was performed under when you spent less than $750,000 for the year. You know, that is just an extra bullet point, because that technically is covered in the, you know, in accordance with subpart F, since that's the requirement that triggers the single audit. But you know, if you don't expend more than $750,000, the U.S. government is saying, all right, we don't need you to go through the full compliance audit. You know, and so for some organizations, it'll change every year. You know, they might spend $800,000 one year and have a single audit, and then the next year only spend $700,000, and then therefore not require the single audit. So, you know, ensuring you have good cutoff procedures to know how much you expended, and that's a key word there for the single audit, is it's the amount of federal expenditure. So not cash receipts, not revenue, it's the amount you expended during the year. That really is the threshold for whether the single audit is required or not.
Joe, does this also apply for a program audit?
There's a separate section for program audit, and so if your federal agency requires a program audit, then it would be allowable. So, yeah.
Thank you.
Yep. And then, you know, just a little bit more on the audit costs. You know, the cost of the financial statement audit that has no federal awards can be allocated via the indirect pool. You know, so that's a normal cost of doing business type thing. And so it can be in the indirect pool. You know, and some organizations end up doing an agreed upon procedure engagement with an audit CPA firm to monitor their subrecipients. You know, it's part of your monitoring procedures for your subrecipient monitoring, which you're required to do based on the uniform guidance. You know, and those can be charged directly to the federal award, you know, if they meet the following criteria. So the agreed upon procedure has to be conducted in accordance with GAS, which is, you know, governmental auditing standards that the auditors will follow. You know, paid and arranged through the pass-through entity. So, you know, if you tell the subrecipient to go and monitor themselves and hire an auditor to do an assessment, you know, the guidance would say that is not an allowable cost. So the pass-through entity, you know, that's responsible for the actual monitoring of the subrecipient needs to be the one paying and arranging the situation, because it's really an extension of your control structure for monitoring the subrecipient. You know, and then they really want you to limit the scope to one or more compliance areas. You know, really focus on allowable costs or inactivities, you know, disallowed costs. eligibility and reporting, making sure what the subrecipient is reporting up to the pass-through entity is based on fair and accurate data and information.
Okay, so you see there the shakedown, but basically what the government's saying is that if you owe money back to the government for a variety of reasons, whether it was ineligible payment to somebody, it was overpayment, duplicate payment, and the like, they'll fund your ability to pay it back. But most of it is really just you uncovering something and then, of course, sending it back to the government. Next slide. Conferences, the cost of meals and meetings. I must have gotten out of line here. My apologies. So meetings and conferences for the primary purpose of dissemination of technical information is allowable. And so we can define them as a meeting. It may be a group of you going off on a management retreat kind of thing, a seminar, symposium. All of those generally, as again, as Joe had mentioned, as long as the costs are reasonable, then you can get recoverage for that. Next slide. Well, I got ahead of myself, but basically at conferences and other meetings and so forth, the cost of meals and refreshments and all of that generally are allowable. However, certain agencies, I know Department of Justice, I know under HHS, HRSA, Brian White, because basically I've dealt with those programs, they have been very specific and said, even though the general rules for OMB under cost principles allow it, we will not, we don't want to pay for it. So you should recognize that agencies can have more restrictive rules and we must follow them. And generally they would be hopefully in the terms and conditions. Sometimes it's spelled out in a longer document. Sometimes they give you a web link. But the bottom line is, in some instances, unfortunately, it's not allowable. Now, interestingly, the cost basically for you to, if you need to provide dependent care and you're going on travel for these conferences, just trying to figure out who to do it, that's allowable, but that most people don't have to pay for that. However, National Science Foundation has a unique positive thing that if you have to go on these kinds of conferences and participate and you're traveling, and the actual cost of the dependent care is allowable, which is unique, and it's only NSF. Next slide. Contributions and donations that you provide to other organizations certainly are unallowable. And also, when you get in-kinds, whether it be direct or indirect, those two must, if it's indirect, must be removed from the pool and they're unallowable. If it's a direct cost in kind, it stays in the allocation base because the way it works is under modified or any other base is that unallawables remain in the base and receive their share of the indirect cost, but they're not. Now, section 200.306 is the section that deals with how to value those things. But again, whether it's direct or indirect, it's unallowable as in kind. And most of you probably say, well, I know that, but sometimes when you invoice or before you invoice, you have an indirect rate and you might have it sitting in a pool. And it's probably safer just to put any in-kind that's of an indirect nature, to put it in the unallowable section so you don't inadvertently include it. Next for Joe.
Right. So the next one here is depreciation. And depreciation is an allowable cost. Depreciation for building, capital improvements, or equipment. And an important thing to keep in mind when looking at the cost principles, is that the U.S. government has specific definitions for a lot of terminology that's used, and those definitions are found in 200.1 of 2 CFR 200. And so capital improvements, equipment are both defined specifically there, and we'll talk a little bit about them when we get into the equipment cost principle. But in general, depreciation is allowable. It needs to be based on the acquisition cost if you purchase the asset or the fair market value of a donated asset. Assume you use the straight line method to depreciate fixed assets, but whatever method you use to calculate your depreciation, you cannot change and flip-flop back and forth, which is consistent with how you should be depreciating your assets for your financial statement purposes under GAAP. You can't pick and choose based on each asset how you want to depreciate the asset. So, the federal government expects that you're being consistent with how you're depreciating things for financial statement assets or financial statement purposes. And typically depreciation is allocated indirectly. So the next area, employee health and welfare costs. So, things that you incur to improve the working condition for your employees, and and just make it an overall better place to work. We all spend so much time at work, as organizations and companies try to do things to enhance our lives and make work more enjoyable and a good, healthy place to be. The U.S. government says those type of costs are allowable costs, as long as they're in accordance with your organization's established policies. In the prior regulations, they listed out some specific items that they considered to be employee health and welfare costs, and those were deleted out of there. Not to mean they're not allowable costs anymore, but I think they got a lot of questions for items that weren't included in the list. So they decided to remove the list and just say, in general, if you're trying to improve the working conditions or, relationships with your employee, that those are allowable costs as long as they're in accordance with your established policy and practice.
Okay, so as you can see, the time is getting short. So what Joe and I are going to do is we're going to do, like in football, a 2-minute drill. We're going to just kind of list these items, and we're only going to say very little about it because we at least like to cover it for you. As you know, generally entertainment is unallowable. We'll go to the next slide.
Yep. And equipment is allowable. You need to follow your own capitalization policy, but your capitalization threshold cannot exceed $5,000. So it's whatever's the lesser of the two.
So exchange rates is a newer cost principle that came with the new uniform guidance. And basically the key here is that the government wants to make sure it has enough money. There's a exchange, and it keeps eating up the cost that was set aside for these things. And so the basic key to that is that you're watching the currency fluctuations as it's going through to make sure you have adequate funds. Joe?
Yep. So fines, penalties, damages, or other settlements. On the next slide, essentially, if you're having to pay a fine or penalty for doing something incorrectly, the U.S. government doesn't want to pay for that. That's your cost burden, and they're almost always unallowable.
For fundraising and investment management costs, all of that pretty much is unallowable. For fundraising, it's treated as a direct programmatic or direct functional area. So it actually goes into modified total direct cost base, but it's all unallowable only if you're maintaining the assets and that kind of thing for security purposes. That would be allowable. And we will talk later, Joe will talk later about proposal costs and where that sits. Joe?
Yeah. So gains and losses when you dispose of depreciable property or other capital assets are allowable. You have to record them in the year in which the disposal occurred, and you calculate it based on what the undepreciated balance is compared to what you disposed it as of, and either add that money back to the federal program or include it as a expense.
Goods and services for personal use, like automobiles and the like, or even for cost of housing to support people, even if it's reported as a taxable income, all of that is not recoverable. It's unallowable. Joe? Yeah.
So insurance costs are generally allowable as long as they're required to support the federal program or conduct operations and are along the lines of sound business practices. As Paul mentioned previously, insurance that benefits the employee or trustee or represents income to a family of employee is not allowable though. can go on to the next one.
Okay. As we would understand, lobbying is completely unallowable, and it's a very dangerous thing for anyone to charge of any dollar amount at all. The government does not want $1 of their federal money to use to influence a campaign, to tell someone an idea, what we call propaganda, or letter writing, rallies, fundraising, whatever it is to promote a cause. It's not allowable. Next slide basically says there are, of course, a few exceptions to those, like you're providing a technical factual presentation, particularly as testimony before Congress. Now, the next slide is some under the IRS that you would have certain allowable activities, and that would be a nonpartisan analysis study or research. And basically, you're helping a legislator with some technical advice. But if you are doing this, no matter what, you're supposed to keep time logs if the employee engages in more than 25% in a calendar month. Okay, so we'll go back to Joe.
Yeah, so maintenance costs are allowable costs. To keep the equipment in working function is expected. They're not allowable though if it prolongs the useful life of the asset or adds permanent value to the asset. Think of standard repair maintenance costs allowable, but enhancing the asset and prolonging the useful life is not allowable. And then material and supply costs, including computing devices. Again, go back to the actual definitions for more details on the exact wording for these. But material supplies, other things necessary to perform the award are allowable costs.
So memberships, subscriptions, and professional activity costs, those are allowable because it's for a technical or a business purpose, or subscriptions to like the periodicals that go for. Think about auditors, or accountants having the CPA, AI CPA membership. So that would definitely be allowable. Next slide. Organization costs is probably some people want to scratch their head and say what that's about. You have one organization and you're now going to set up an affiliate that's like a foundation to deal with some of the fundraising issues. The cost for incorporation fees, management consultants, legal and accountants, or your internal people, you're supposed to track that. All of that would be unallowable. Joe?
Yeah, so participant support costs, what this really is paying any costs for stipends or travel allowances for participants or trainees, so not your employees. So think if you were paying some homeless citizens to come and attend a hand washing hygiene training type thing, and you were giving them some sort of stipend to get them to come and listen to the session. These costs are allowable, but require prior approval from your federal awarding agency in order to make them allowable costs.
Okay, so planned security cost. Obviously, that's to protect your facility, and it deals with equipment, uniforms, wages, barriers. Hopefully, your security guards are not sleeping, but they're all allowed. Next slide. Professional service cost is really a little bit more involved, and the basics to it is there is no one way as to whether it's allowable or unallowable. There's certain things that the standard wants you to look at. The nature and scope. Do you really need these consultants? Can you do it in-house versus outsourcing it? Those kinds of things are some of the issues. If you go to the next slide, and yeah, it goes through impact of federal awards on the non-federal entity and what specific requirements or problems. And it can be an indirect or it can be direct. Let's go to the last of that slide. It's interesting that the government distills it for an adequate agreement. Basically, do you have a statement of work? Do you stipulate the performance period, the billing rates, and at least a termination clause? Joe?
Yeah, so proposal costs, the federal government say are allowable costs, whether you're proposing on federal or non-federal awards or projects. So of course, these would go in your indirect cost pool. And the key thing to remember here is, the federal government's really making a differentiating between proposal costs and fundraising costs. So proposal after, restricted project funding, whereas fundraising costs is really more of your unrestricted fundraising costs, getting contributions from individual donors and so forth. So fundraising costs are not allowable, but proposal costs are allowable in the indirect costs pool.
The interesting thing with relocation and recruitment, and there's a lot of thing in both those areas, so it's have to look at specifically. It's just that if an employee that you relocate to your facility or to a specific area to perform work, if within the first 12 months they voluntarily resign, then you're on the hook for the relocation costs. Joe?
Yep. So rental costs are an allowable costs, but there's some criteria you have to follow. They have to be reasonable at the time, and you have to look at the market conditions to, determine if renting versus buying, it makes the most sense for the situation. But if you meet the criteria, rental costs are an allowable cost. And under the GAAP guidance, as far as capital leases and under the new ASC 842, if you have a right to use asset, that is considered not to be a rental cost, and so then therefore would not be an allowable cost.
Well, we're just about winding down. We're going to make it to the finish line here. But tax and VAT, the new thing is that VAT or value-added tax is allowable or required, and also taxes to pay to a local government. And one of the things is, that wouldn't be unallowable is if you've given an exemption certificate and you still pay the tax, which isn't too bright, then it would be definitely unallowable. Joe, I'll let you take it home with the travel cost.
Yeah, so travel costs, this is another section. There's a lot of different detail in here, but in general, travel costs are allowable, as long as it supports the official business of the organization and is necessary to perform the objectives of the federal award. Again, you want to make sure you have a written travel policy that employees follow. Otherwise, the government will expect that you follow their travel policy, which is not going to be in your best interest in most situations. For any organizations that are traveling internationally, you'll have to comply with the Fly America Act, which there's a lot of little nuances with it, but essentially they want you to fly a U.S. flagship carrier, when going internationally. So that is the general travel principle.
Great, thanks guys. And so with that, I think we have maybe time for one, maybe two questions that we received from the audience. So the first one I think I'll direct to you, Paul. So the question is, our organization is a commercial firm that has both grants and cooperative agreements. So do we follow the uniform guidance subpart E cost principles that seem to be for nonprofits?
No, you would follow the federal acquisition regulation for commercial. It's a FAR subpart 31.2.
Okay, perfect. Thanks, Paul. And then the second question, I'll direct it to you, Joe. In the November 2020 revision to the uniform guidance, were there any changes to the cost principles?
Yes, there were. There was a new cost principle for telecommunication services and equipment, which really a lot of people kind of refer to it as a China ban. So not using or buying any equipment from Chinese telecommunication companies, and so that was added into the cost principles in the most recent revision.
Okay. All right, perfect. Well, one major announcement actually before we wrap up. So parts 3 and 4 of this webinar series, they've been canceled. Instead, what we're going to do is we're going to offer a series of articles on indirect rates covering the same content, but that's going to be made available on our website. And so with that, we'd like to thank everybody for attending. We encourage you all, as always, to follow us on social media at GRF CPAs and visit our website at www.grfcpa.com for upcoming events and alerts. And just remember to complete the survey if you want the CPE credits. Thank you and have a great day.